Hello everyone, great to have your company on 𝐾𝐿 TV. I'm Sage and you're watching the Buzzing Trends show. In the first segment today we will be looking at these ASX listed mining stocks which have announced dividends recently, and we'll also deep dive into their financials to explore the latest news from the company. As everyone knows, Australia's share market is known for its dividend paying stocks, and therefore in the last segment I'll share why do some investors prefer dividends over a long term. So let's get started. The mining sector has been one of the biggest beneficiaries of the global efforts to bounce back from the pandemic, and the huge amount poured into the economic recovery has boosted the demand for commodities, including iron ore, aluminium, steel, further pushing the prices higher. And iron ore, the world's second biggest commodity after crude oil, has been a key driver for record earnings of the world's leading miners, including Rio Tinto, BHP, Vale, Glencore and Anglo American. Recently, the prices of iron ore hit near $230 per tonne in 2021, a level not seen in decades. And copper and steel prices surged to multi-year highs, with the demand for coal skyrocketing too. However, the prices have recently plummeted due to recent cases of the coronavirus Delta variant rising, and also China's move to curb exorbitant commodity prices and reduce the production of steel on environmental concerns has further weighed on the prices. Now, with the earnings season underway, the world's biggest miners are unveiling their quarterly results amid this year's commodity boom. And the first company on our list today is Fortescue Metals. It is an ASX-listed iron ore company with its primary assets located in Australia's Pilbara region. Founded in 2003, Fortescue Metals has become one of the leading iron ore producers globally. And the miner recently announced its June quarter results, stating a record iron ore shipment of 49.3 metric tonnes for the quarter and 182.2 metric tonnes for financial year 2021, surpassing the guidance range. The mining giant has witnessed significant growth in dividend payouts in the last 4 quarters, and Fortescue Metals has paid an interim dividend of $1.47 Australian per share in March and has an annual dividend yield of 10.85%. Moving on now to the next company on our list, Rio Tinto. It is also an Australian-based metals and mining company with operations in nearly 35 countries around the world, and the miner released its half-year results on 28th July 2021. Rio Tinto shipped 154.1 metric tonnes of iron ore and produced 152.3 metric tonnes of iron ore in the first half of 2021 from its Pilbara operations in Western Australia. The production was 5% lower than the previous year's first half due to bad weather conditions and COVID-19 restrictions. It has increased its dividend significantly as well, from 5.171 Australian dollars per share to $7.60 Australian dollars per share, with a pay date of 23rd September 2021. And Rio Tinto has an annual dividend yield of 9.95% as of 10th of August 2021. The next company making our list today is BHP Group, and it is one of the leading resource companies across the globe with its iron ore operations in Western Australia. The miner has produced 65,245 thousands of tonnes of iron ore during the quarter ended June 2021. And BHP's South Flank iron ore project located in Western Australia achieved its first production in May 2021. The company recorded a gain of 9% in its iron ore production business as compared to the previous quarter. And the group paid a fully franked interim dividend of 1.311 Australian dollars per share on the 23rd of March 2021 to its shareholders. And BHP Group has an annual dividend yield of 3.99%. Well, these were the ASX listed mining stocks that have announced dividends recently. It's time for a short break, but please stay tuned with me as I'll be sharing some interesting insights on why some investors prefer dividends over long-term capital gains. Hi, I'm Sage, and get ready to take the crypto ride with me on 𝐊𝐿𝐴𝐚 TV. Watch the Crypto Buzz every Tuesday and join the excitement at 𝐊𝐴𝐚 TV. From Bitcoins to NFTs to Dogecoin and DeFi, we have updates about everything around these digital currencies. Understand the investing rationale and the risks involved in the space with me, Sage, on Crypto Buzz. Keep watching 𝐊𝐴𝐚 TV. Welcome back, I'm Sage, you're watching the Buzzing Trends Show, and before the break we discussed the record earnings of the world's leading miners, including Rio Tinto, BHP and Fortescue Metals. And in this segment, let's understand why some investors prefer the dividends over the long-term capital gains. Investing in stock markets has been typically classified according to various characteristics of the assets and their respective risk-to-reward ratio, while some investors and traders function by estimating a set rate of return, and some manage to contain the overall risk of the portfolio. Next comes investors who remain dynamic with the choices of investments, as they tend to work with an objective to maximise the returns by not taking undue risks. And on the other hand, there is a strong bifurcation of the market participants based on types of returns, as some investors look forward to acquire a sizable chunk of capital gains over the years, whereas others are happy to receive the periodic dividends. Receiving dividends after certain intervals on the total numbers of shares is primarily considered a topping of the regular capital gains. And this translates into a lucrative opportunity for investors, as they garner a second income in the form of dividends every time the company decides to distribute the surplus income to the eligible shareholders through dividends. In addition to this, companies who pay dividends regularly also deliver returns close to the rise in the benchmark index. And during the difficult times, the shares of a company that regularly pays dividends generally remain in the positive territory in the long term. On the other hand, in case of people who chase high return stocks, such as stocks with dividend yields below 2 to 3%, find such stocks less attractive as compared to the shares that have consistently posted an annual return of more than 15%. And moreover, the individuals end up paying less taxes as compared to the people who have invested in dividend-intensive stocks, as income from dividends may be taxable beyond the stipulated threshold fixed by the income tax authorities. Well, investors should diligently study each stock before exploring it further. And thanks for your company on that report. But that's all the time we have, and it's time to wrap up today's show. I hope you found today's show informative, and stay tuned for more news and updates on 𝐊𝐴𝐚 TV Live. This is Sage signing off.